Welcome back to Market Minutes, everybody. Today I'm joined by Jen Harrop, Senior Vice President of Fund Management. She's in charge of working with our institutional partners. She oversees our CMHC program. Happy to have you on today's episode, Jen.
Thank you for having me.
Last year, CMHC made some rule changes. MLI Select, we saw lots of applications going through. Nuts and bolts, how has that impacted what we're seeing, the immediate impact and then looking at it 11, 12 months later?
So deal economics, is as a lender, very front of mind for borrowers as well. So certainly there was a big rush to try to get in before that deadline. And, it does place a little more strain on debt service coverage because we calculate on a net, not a gross. So there's a bit more care that goes into the underwriting there. In terms of borrower behavior, less borrower behavior, but just market dynamics, when you have a period of time of 10 or 15 days where you submit a month and a half worth of applications, there is naturally backlog after that. There's no getting around it. So we did find that it was a little bit longer to get through the process. On the fund side, we saw that result in slightly longer terms. No increased risk, just things taking a little longer, and frankly, a loan that's seasoning a little bit, not the worst.
So when you say our fund side, just to be clear, you're talking about not the conventional takeout, you're talking about the bridge.
Exactly. So there were a lot of people that we didn't intend to take into any kind of bridge financing. They were ready for stable debt, but we ended up putting bridge loans on properties where we didn't expect to, either to facilitate a closing that had to happen or to facilitate an ETO to get something done. We're happy that things have stabilized a little bit now, though, and the machine is working at its intended pace again.
Some of those bigger changes that we've seen, how has that impacted borrower behavior down the road or where we are today? Are we, we're certainly seeing fewer new starts. We're seeing elevated interest rates, so people who are refinancing to this market may, be caught a little bit short-sighted. Were these all a result of last year, or is this new changes? Just give us kind of what the landscape is looking like today and as a result of some of those changes.
Yeah, those changes and also changes to the market. So some of those changes looking like higher premiums, that doesn't impact right away. I think we're going to see that more on the renewal side. It is going to impact debt service coverage as we look at what's been a pretty volatile rate environment over the last several months. We're seeing projects come online, construction finish, and deliver and need to take out with a completion takeout or under the same certificate. And the max rate is not high enough to bear what the market currently is. We do our best, but if I had the crystal ball that could tell me what an interest rate would be in 12 months, I would be fabulously wealthy and possibly not sitting here, although I do love my job. So there's a bit of dealing with that. And the question mark for borrowers becomes, do I go in at a higher max rate and deal with lower proceeds? Or do I not roll the dice, because it's a calculated decision, but do I look 12 months out and say, I think I'm going to either hit or exceed my rental projections, a little bit tough in this market, or I think I'm going to be at a lower vacancy or something like that to say, you know what, I'm okay to take the risk of buying down a max rate or having to put equity in at the end because it works for my development yield today.
So a borrower or a developer who's thinking about it from, with those different constraints, a lot of them must be thinking, these have to be long-term assets. I have to be I can't be projecting, short-term returns, 3 to 5 years, because if I'm building a building today and I have to buy down my rate or come up with more or equity, and we're seeing softening rents, you have to be thinking these are long-term generational assets, and I just want to, stabilize my asset and keep collecting rents. And
yeah, there's not a lot of in the way of merchant building where it's building to sell or building to not flip, but to dispose of at the end of construction. So most developers are looking at it and saying, okay, maybe the year one return isn't there. What does year 5 look like? What does year 10 look like? And can I do this at a cost that is reasonably comparable to what I could get in the market otherwise? Should I go and buy at a lower cost base? The cheapest building is the one that's already built. So do you go in and refurbish, or do you go and start new, knowing that all of your systems are brand new? You've got no major CapEx for 10 or 15 years, and you've got a long-term asset that can, as you said, be generational, something that works for a long time.
So is CMHC really the only competitive option as a result of all these aforementioned challenges that developers and borrowers are having, or are there conventional lenders who could suit the needs of the market?
Yeah, I mean, I think CMHC has been reasonably vocal that they don't need to be 100% of the multifamily financing space. They're quite happy for the markets to come in and do their market thing. So we are starting to see that conventional lenders coming in and offering some things, being able to compete on pricing and being able to, extend maybe a little bit of a longer AM, becoming a more prevalent factor. It's still widely dominated by CMHC, especially on the construction side, but we're starting to see that conventional debt come in and make more of an impact.
It's interesting. I didn't know that they had made this decision that they want more of a balanced market, because I've read that they've just increased their capacity by 33% from 60 billion up to 80 billion. So
Yes.
are they expecting the non-conventional, non-insured business to also be, all of a sudden coming to market and at that quantum?
So it's actually very interesting, and this is where I'm going to get a little bit nerdy, and I'll try not to go too deep because it bores everybody but me. But CMHC has two pillars that they work within. They've got the loan insurance, and then they've got the securitization of the capital markets, which provides liquidity and capital to the market. And that's the piece where they've increased all the funding. So they've increased it by 33%, but they've insured a lot of construction over the last few years. So that does not access capital markets debt in the way that term debt does. Sort of boiling it down, that bucket of money is for 5 and 10-year loans only. It's not for construction. Construction is sitting on a balance sheet somewhere, sitting on a bank's balance sheet. It might be going into capital markets in a different way that's not supported by CMHC. But what we've had in the last year or so is not enough capital to support the 5 and 10-year, the 5-year demand specifically. 10-year loans have been a little bit difficult to qualify. So a lot of the volume is going 5-year. And really that increase, I think, was looking to keep up with the demand, to make sure that there was adequate liquidity in the market, because we were struggling with that. All lenders were struggling. It was starting to impact loan pricing. And that's not going to impair, I think, the conventional lender side, because there is so much new product coming online.
So the last question I had is borrowers navigating today's market. You look at close to 100 deals a week in whether it's the CMHC programs, bridge financing, just across the platform. From your perspective, obviously we're only trying to do good credit on good deals. Give us that framework of good, the good, the bad, the ugly, I guess, of deals structuring.
Yeah, I mean, look, there's always a way to get something done. It's a matter of how it's structured. So we are looking a little bit harder at collateral. Something where we might struggle a little bit might be if a borrower is stretched, if a borrower's got a lot of properties that are just barely cash flowing, or have a lot of construction loans. We're going so deep as to dig into, okay, well, what's your equity requirement here and here and here and here? And where are we going to make sure that you're coming up with all this cash? I always say from a credit perspective that I'm not doing you any favors if I give you a loan that you can't afford. You lose money, I lose money, nobody's happy. So what the good deals are is they're realistic about values and rents specifically, as we're in a tougher rental market. We're not projecting growth in rents unless there's a really compelling reason. It's not to say that we won't, but it's not just I threw a coat of paint on it, I relisted it, it's $600 more. We're not in that market anymore. There was a period of time where that was just what was happening because it was coming up, but they've softened a little. So that's the struggle. The struggle is the softening rents, I would say. But the success is in proven operators, people who really know their craft. They are full-time investors. They are doing this. This is their livelihood. This is what they do. I think we're going to see some of the more speculative or side of the desk investment probably wane a little bit over the next couple of years as things settle a little.
We have a new segment on Market Minutes called Market Minute.
Market Minute, okay.
We're going to ask you some rapid fire questions. So 60 seconds will be on the clock. We'll see how many of these we can get through. Best podcast that changed the way you think about business.
Pass.
Okay. Not a podcast person?
I mean, I listen to an F1 podcast. I listen to the Survivor podcast with my kids, and I'll listen to comedy. But no,
Not business.
my car time is not my business time.
Okay. What was your first job and what did it teach you?
Gosh, I was a tennis instructor at a children's tennis camp. So I learned that I should not be a teacher.
Beach vacation or city trip?
Ooh, city trip.
Most interesting secondary market in Canada right now?
I think Waterloo's going to be really interesting.
One book everyone on your team should read?
Noble House.
What is one quality you look for when hiring?
Attitude.
One word that describes your approach to risk?
Informed.
What is your outlook on multifamily cap rates? Thank you very much, Jen, for joining me in the podcast. Thank you for joining in this episode. Thank you for being part of Market Minutes.
Thank you, Chaim. I've had a really good time.